indicator reports, produces special commentary, and contributes to the company's weekly economic and financial commentary. Sarah frequently speaks about the economy to the national media, including Bloomberg News and National Public Radio. Prior to joining Wells Fargo in 2010, Sarah worked as a research associate for the Federal Reserve Bank of Richmond. Sarah earned a BA in economics from Tulane University in New Orleans and an MSc in local economic development from the London School of Economics. She's a member of the National Association of Business Economics and the Charlotte Economics Club. So please welcome Sarah House.
Well, good morning, everyone, and thank you for having me. So this morning I'm going to give an update of where we see the national economy going and also what we see a little bit on the international stage, since we are seeing some interesting divergence there that's going to have an important impact not only for U.S. growth, but also the timing of monetary policy. We're kind of entering a really interesting year where it looks like we might get our first tightening of monetary policy that we've seen in nearly a decade. So looking at the overall outlook for U.S. GDP, so we're looking for growth to actually accelerate this year. So we're a little less optimistic than some of the consensus numbers that Dr. Evans showed, where we're looking for GDP growth to only come in at about 2.7%. So that's still a step up from the 2.4% we saw last year. And it's still above the potential rate of growth we think that the U.S. economy can grow based on what we're seeing in terms of productivity trends as well as labor supply. And part of that, a little more pessimistic than, some other numbers that are out there, I think is coming from the first quarter. So while it's been, awfully warm out here, that hasn't been the case back east and in many parts of the Midwest. And it looks like we have seen a little bit of a hit to retail sales and residential construction. But overall, we think that momentum is going to pick up as the year progresses. And the big driver there is going to be consumer spending. But we're also going to get some help from other sectors of the economy, including pickup in government spending, residential investment, and business investment as well. Now, the biggest headwind to growth this year is actually going to come from overseas demand. So we're looking for global growth to only average or to come in right around what we saw in 2014. But keep in mind that's even as the world's biggest economy, us, is increasing. So by de facto, we're actually expecting slightly slower growth among the rest of our trading partners. So we see in China, growth is slowing down there. We think growth will come in probably less than 7%, which would be the lowest rate of growth since 1990 as they rebalance their economy away from too much business investment and more towards consumer spending, but that's going to take some time. We're also seeing some weaker economic activity in Latin America. So Brazil and Argentina are in recession right now, and we're seeing some other weakness given the reliance on commodities in many America as well. And then Europe is still struggling for growth. So the recent numbers over the past month or two are actually looking a little bit better, and we think growth is going to pick up a little bit, closer to about 1.5%, but still relatively weak. And but part of that better outlook is coming from the fact that the ECB has taken some extraordinary measures, and they're going through QE right now, and they're to our increasing monetary policy accommodation. We're seeing that across many countries. I think year to date we've seen about 24 central banks cut rates already. But meanwhile, the U.S. is talking about going the other way, and so that's led to a pretty sharp appreciation in the dollar. So on a trade-weighted basis, we've seen the dollar increase about 12% over the past year, and so that's going to impact our exports when we look at not only kind of sluggish growth in our trading partners, which is actually much more important than just the value of the dollar, but the strengthening of the dollar will be an impact there too. So when we look at kind of what's weighing on GDP growth, it's going to be this divergence where with the U.S. consumer picking up, we're actually going to see a much faster pace of import growth relative to exports, and so from that end. Now, should we really be worried about this slowdown in global growth, or can the U.S. continue to go it alone? Well, I think if you look at some previous periods of weakness overseas and kind of how the U.S. fared, it's interesting to note that when we look at global industrial production as a proxy for global GDP, in the last instance where you did see a big dip in global activity is really the U.S. the global economy down. So we saw that in 2008 with the global financial crisis and really the subprime issues that originated here in the U.S. Mortgage market. But even in 2000 and 2001, you saw that the U.S. economy started to kind of turn down and drag the global economy. But if you go back to the 97-98 period where you saw the Asian financial crisis and eventually the Russian debt crisis, U.S. growth stood pat. It continued to grow at close to 4%, and so to that end, we do think that the U.S. can go alone if things here are looking pretty good, which we believe. Now, so why is it that the U.S. looks somewhat, it should be able to continue to grow even as we are seeing some weaker growth overseas? Well, if you look at the value added that actually comes from foreign demand here in the U.S., it's actually extremely low when you compare it to other countries. So once you kind of factor out, so exports account for about 13% of GDP, but some of what we export, we eventually import back in. And so when you kind of net that out, foreign demand only accounts for about 8% of overall GDP. So still relatively low, and part of the reason we think that the U.S. can, in fact, continue to go on this divergent path where they continue to grow at a faster pace, even as the global economy struggles for a little bit. Okay, so that domestic demand higher. Well, one of the big changes that we've seen over the past year is the fact that we've seen government spending go from a headwind to now a modest tailwind. So we saw government for about 4 consecutive years. We typically don't see such a long stretch of that coming out of a recession. But we've seen state and local governments get their budgets in order, and they're starting to spend again. Federal spending is still a little bit of a drag, but we think by 2016 that'll pick up as well, and so you'll get an increase to government investment, which will help support GDP growth. Business investment is actually going to be one area where we're expecting a little bit slower growth in 2015, and a lot of that's coming from mining activity. So we've seen a lot of reductions in CapEx plans for energy companies, and so even though mining only accounts for about 7% of investment in structures and equipment and software, which feeds into what we call business fixed investment, it's accounted for about 15% of the growth. So it's been an outsized contributor. But at the same time, we have business investment elsewhere picking up. So if you look at the manufacturing sector, for example, you've seen capacity utilization reach long-run levels, and so we're starting to butt up against some capacity constraints there. We've also seen company balance sheets are looking pretty. They've delivered much more quickly than other sectors of the economy. And at the same time, you still have credit widely available. So we continue to see banks loosen credit standards for companies, and also see increasing amounts of companies increase their demand for loans. So taken together, this is going to help support capital spending in other industries of the economy and offset that reduction in mining investment. So one area of the economy, though, that continues to struggle and is probably the furthest to go in terms of getting back to normal is housing. So a big factor there has been just the slow increase in household formation. So we've seen household formation run below its long-run average for about 8 years. So it's a lot of millennials living at home with mom. Even more parents ready for them to get out and move out into their own place. But of course, when most people move out, you don't go buy a home. You tend to rent for a few years. And so you can see on that right-hand side chart that I have up there that you continue to see really all that net new household formation funneled into rentals. And so you continue to see home ownership decline, and that's having an impact on the pace of sales activity that we're seeing in the residential market. Now, a big factor there, some people worry, well, is this maybe a preference shift? People are scared of housing after seeing prices decline. Millennials, they just want to be able to pack up and move. But really, I think the biggest issue remains the financial barriers. So credit in the mortgage market remains extremely tight. We haven't seen really any loosening like we have in the commercial and industrial loan market, or even in other parts of consumer credit or commercial real estate. And so one of the big issues we have in terms of is you're just not getting that first-time home buyer in, and so that's also limiting the trade-up activity that other homeowners can do. And part of that has to do with the credit profile of younger buyers, which would typically be your first-time home buyers. And really, they're between the credit scores and the student debt, kind of coming up with that down payment remains very tough. You just particularly when banks are still only lending to only your prime borrowers. So with some of those financial hurdles still in place, we look for residential construction to starts to improve about 13% this year, but we're going to continue to see a pretty large share of that in the multifamily or apartment sector. So given that it's still very tough for folks to get into a single family home. And that's going to have important implications for GDP growth when you think of the value of a housing start for an apartment versus a single family home. You're using less labor to build it, less materials, even the ripple effects in terms of the amount of furniture you're going to put in that. And so you're not going to get as big of a punch each start in terms of your GDP contribution. But we do think we'll see a pickup in single family homes this year. And that's coming from the fact that you are seeing the traditional buyers are in a better place to come back in given the job and income growth we year, and also the fact that we don't expect mortgage rates to rise too dramatically once the Fed begins to tighten later this year. Now, of course, if you really want to know where the U.S. economy is going and kind of what's going to, if you're going to get it kind of shift into a higher gear, you're going to need help from the consumer. And this is actually the area where we think we'll see probably the most improvement in 2015. So we're looking at real consumer spending to increase 3.2%, which would be up from about 2.5% last year. And while that's still lower than what we've seen in the previous cycle, we were kind of up to 4% levels, and even expansions before that where you're seeing consumer spending increase 6-7%. We think this is more sustainable for a couple of reasons. So one of the big factors, if you look at debt service as a share of monthly income, so how much out of monthly income consumers are devoting towards debt payments or other similar financial obligations, like if you lease an apartment, making that equivalent to debt, you can see that that's come down to about 35-year lows. So that's come from the fact that consumers have really pulled back on the amount of debt they're taking out. Some of it has been write-offs, but really the big factor here is the interest rate channel. So with the Fed having lowered rates to zero and been on hold for so long, you continue to see with rates falling so low, that's freed up a lot of extra room in consumers having to devote to less of that debt payment is going towards interest. And so we do think that there's a little bit more room for maneuver in consumers' budget. So we're also seeing a little bit of a tick up in consumer credit, so that's going to help support consumer spending as well. So a lot of this has been driven by autos and student loans, but more recently you can see on that left-hand side chart, that lighter line, we're seeing revolving credit come back. So that's tends to be more discretionary, and so it seems like consumers are feeling a little bit better about their future income prospects and a little bit of credit loosening there as well. If you look at that right-hand side, household delinquencies, you can see that overall general credit quality continues to improve across different types of household credit, with the major exception being student loans, which is more of a secular trend and not so much indicative of where we are in the business cycle. So one of the big changes this year for the consumer will also be lower gas prices. So even though we've seen them tick up since the beginning of the year, they're still about 30% lower than a year ago. So that's going to be a substantial amount of savings for a lot of households. So it's not going to be even across the income spectrum. So you can see that lowest income households are actually, not surprisingly, they're going to be saving the less, and they're going to be saving the least since they spend the least. But your middle income households are actually going to be the biggest winners in terms of the share of their budget to gas payment, to gasoline spending. Now, we haven't really seen much of that savings, though, be channeled back into the economy. We've seen a little bit seems to be going towards people eating a bit more, but really a lot of it seems to be going to savings. And the savings rate is this blue line here. It's actually inverted on this chart, but we've seen savings increase highest rate in about 2 years. So this is even as income growth is picking up. So it seems like folks are saving some of that money from the lower gasoline prices. But we've seen a kind of a decoupling between household net worth and the savings rate. So typically, as household net worth rises, you see that savings rate decline. But we've seen that break, and so it does suggest that there is room for some spending to be fueled by current savings right now. And of course, for most households, what matters most in their spending decisions is what's going on in the labor market. This has really been the area where we've probably seen the most improvement over the past year. So if you like to take the really broad look at slack in the labor market, what we economists call the U6, who are employed part-time but want to be working full-time, as well as people who have been out of the labor force but have looked for a job within the past year and would take one if it were available. That's come down by about 1.5% over the past year. The unemployment rate, which you guys are probably most that headline, has come down, but has continued to fall at around 1% a year, and we think that pace is likely to slow a little bit in the coming quarters, but we're getting pretty close to what the Fed would consider full employment. So that's that red band there, and they're looking at unemployment to full employment to be somewhere between 5.2%, and we think we'll get there by the fourth quarter of this year. Now, part of the reason they don't think we're there yet is we haven't seen very much of an acceleration in wage growth. So they think that this is really a sign where, okay, we no longer have slack and we're beginning to tighten, where you get that wage pressure heating up. And we've seen a little bit of movement in what we call the employment cost index, wages and salaries components. The average hourly earnings series that you hear about monthly, we still kind of see that skating around 2%, so not much of an acceleration there. But we do think it's coming. So recently, we've heard a lot of announcements from large companies saying that they are raising wages. But also, if you look at small firms, which is this blue line on the chart, the percent of small firms saying that they're planning to raise compensation over the next 6 months has risen to the highest point since the recession, and that tends to lead overall wages in the economy by about 12 months. So it does suggest a pickup is coming later this year. So what could stall that, or what might make us not see that improvement is, well, one, if we get a rebound in the participation rate. So even if you factor out people younger than 25 who are still likely to be in school, and older folks who are likely to retire, and some of that demographic shifts that's putting pressure on the overall participation rate, you still really haven't seen any sort of cyclical rebound in the participation rate of what we call prime workers. And this is more than 5 years in. So I think there's, the Fed kind of implies, based on their forecast for unemployment, they keep expecting these folks to come back, but we just haven't seen it. And so, but if we do, I think that would imply that we'll get a slower rate of decline in the unemployment rate, and also a slower wage acceleration. Productivity would also be another factor that the rate of wage growth, as well as just how fast the economy can grow. And we've entered a period of very low productivity, and this actually started before the recession, where productivity has only grown a little over 1% in recent years. And this is a problem for wages in that economic theory suggests workers should earn the marginal product of their labor. So if they're not as productive, their real earnings come in less. And you can see how that translates over different periods of productivity growth. So if we did get an acceleration in productivity, that could help real wages as well. So when we look at inflation declined pretty dramatically to right now the PCE deflator, which is the Fed's preferred measure, is only about up around 0.2% over the past year, so well off of its 2% target. Now, of course, a lot of that's been driven by the decline in oil prices, and I don't want to say oil and energy and food don't matter, particularly to this group, but when you look at kind of what's the near-term trend in inflation, we tend to look at the core. So the Fed's going to be focusing a little bit more on this core index, but even there we've seen that slip a little bit over the past few months. But when you kind of break that down, which is the right-hand chart on this slide, if you break it down between goods and services, really all the weakness in core is coming from the goods component. So these are things that are more likely to have, where lower energy prices are likely to have on it, where you do have to produce these goods and get them to market, and so if they're passing along some of the cost savings there, you will see lower price pressures. But also the fact of the stronger dollar, where it's now cheaper to import goods, and so that's funneling through our CPI component through core goods. The services line, so that's the darker line on that right-hand side chart. So services inflation hasn't budged, and I think that's a better indicator that underlying demand in the economy remains strong, but it really is some of these transitory factors that are affecting the current lower rates of inflation. So what does this mean for the Fed? Well, so we have seen tremendous improvement in the labor market, and it seems like momentum there is continuing if you look at initial jobless claims, job openings, some of the leading indicators there. And this is really the number one thing that the Fed has named, particularly Chair Yellen, as what's going to give them confidence to see inflation get back up to 2%. So they've said they'll raise rates even if inflation isn't back to target, so long as they're confident. And a lot of that's going to be based on momentum in the labor market, which we continue to see. So, there's been a lot of discussion of timing, and right now, our official call is September for that first rate rise. But I think a big thing too is not just the when, but how quickly. And so we actually think it's going to be a fairly gradual pace of tightening compared to what we've seen in previous cycles, where in the mid 2000s it was kind of Chinese water torture of just 25 basis points every single meeting. But we think that the Fed's going to try and go a bit more gradually and also kind of be a little more dated and prove to markets that they're not dead set on once they start it's straight to the moon. But also I think the earlier they start, the slower they can go, as well as the potential lower they can top out in terms of their rates. And so I think that's one of the big debates going on among the committee, is getting off those kind of emergency levels and still being rather accommodative and not having to play catch up later on. So the last slide I want to talk about is what we expect in terms of the yield curve. And even as we think that interest rates at the short end are going to increase later on this year, we think that at the long end. And this goes back to what we're seeing in the international economy, where you have seen so much monetary policy accommodation elsewhere that we believe that that's going to continue to make the U.S. look relatively attractive in terms of rate off. Continue to get a lot of demand for foreign, or a lot of demand from foreign money flowing in, and so that's going to keep the dollar relatively strong. But it's also going to keep interest rates at the long end of the curve relatively low. So you're going to have, whereas the dollar is somewhat restrictive in terms of growth, we think that the flows into the U.S. will keep interest rates lower and kind of keep financial conditions easier. Otherwise, if elsewhere in the world rates were also rising, so there's a bit of an offset there that I think the Fed will also take into its thinking. So that's all I have for now. I think we have a couple minutes probably for. Oh, just kidding. So we're going to keep moving. But thank you.